The truth about crypto in long-term portfolios. What if I told you that the biggest mistake most investors make with crypto isn't buying it? It's how much they buy. Today, we're cutting through the hype and fear to reveal the truth about cryptocurrency's role in long-term investment portfolios. Whether you're a crypto skeptic or a Bitcoin maximalist, this video will challenge what you think you know. Hey everyone, welcome back to the channel. Today, we're diving deep into one of the most controversial topics in modern investing, cryptocurrency's place in a long-term portfolio. By the end of this video, you'll have a clear framework for making informed decisions about crypto allocation, backed by data, not emotions. The current landscape. Let's start with where we are today. Cryptocurrency has evolved from a fringe experiment to a $1.7 trillion asset class. Major institutions like BlackRock, Fidelity, and even pension funds are now allocating to digital assets. But here's the thing. Institutional adoption doesn't automatically make crypto a good fit for your portfolio. The traditional investment world has been built on decades of data about stocks, bonds, and real estate. With crypto, we're dealing with just over a decade of price history, and most of that has been during a period of unprecedented monetary expansion. This creates what I call the recency bias trap. Think about it. Bitcoin's compound annual growth rate since 2013 has been astronomical, over 100% annually. But this doesn't tell the whole story. We've seen 80% drawdowns, years-long bear markets, and volatility that would make even the most seasoned traders' palms sweaty. The case for crypto. So why would anyone include crypto in a long-term portfolio? There are actually several compelling reasons, but they're not what most people think. First is the correlation argument. Historically, Bitcoin and other major cryptocurrencies have shown low correlation with traditional asset classes, until they don't. During the March 2020 crash and throughout 2022, crypto moved almost in lockstep with tech stocks. But over longer time horizons, this correlation tends to break down. Second is the asymmetric risk-reward profile. Here's a controversial take. Crypto might be one of the few asset classes where a small allocation can meaningfully impact your portfolio's long-term returns without destroying it if things go wrong. A 5% allocation to Bitcoin that goes to zero costs you 5%. But if crypto fulfills even half its potential, that same 5% could represent 20–30% of your portfolio's value in a decade. Third is the debasement hedge argument. As governments worldwide continue expansionary monetary policies, hard assets with limited supplies become increasingly attractive. Bitcoin's fixed supply of 21 million coins creates a fundamentally different dynamic than any traditional asset. The case against crypto. But let's be honest about the risks, because they're substantial. The regulatory risk is enormous and often underestimated. We're one regulatory crackdown away from significant value destruction. Look at what happened to crypto exchanges in various countries. Billions in value can disappear overnight based on government decisions. Technology risk is equally concerning. While blockchain technology is robust, the ecosystem built around it is fragile. Exchange hacks, smart contract bugs, and technological obsolescence are real threats. Remember, we're still in the early stages of this technology. Then there's the speculation versus utility problem. Despite over a decade of development, cryptocurrency adoption as actual currency remains minimal. Most crypto investment is purely speculative, betting on future adoption that may never materialize at predicted scales. Market maturity is another issue. Crypto markets are still dominated by retail sentiment and technical trading rather than fundamental value assessment. This creates extreme volatility that many long-term investors simply cannot stomach. The allocation framework. So how do you think about crypto allocation rationally? Here's my framework. Start with your risk tolerance, not your return expectations. If a 50% drop in your crypto allocation would cause you to panic sell or lose sleep, you're allocated too heavily. Period. Consider the smartphone test. In 2007, most people couldn't have predicted how smartphones would change the world. Similarly, Blockchain technology might create value in ways we can't currently imagine. But remember, even revolutionary technologies can have terrible investment returns. Just ask anyone who invested in dot-com stocks in 1999. For most long-term investors, I suggest the 5 to 10% rule. Never allocate more than 10% of your portfolio to crypto and start with 5% or less. This gives you meaningful upside exposure while limiting downside risk. Diversify within crypto if you're going to invest. Don't put everything in Bitcoin. Consider Ethereum for smart contract exposure and maybe one or two other established protocols. Avoid meme coins and highly speculative tokens unless you're treating it as entertainment, not investment. Practical implementation. If you decide to include crypto, here's how to do it responsibly. Rebalance regularly, but not obsessively. Quarterly rebalancing prevents crypto from taking over your portfolio during bull runs while ensuring you maintain exposure during bear markets. Use dollar cost averaging for initial allocation. Don't try to time the market. Spread your purchases over 6-12 months to smooth out volatility. Secure storage is non-negotiable. If you're investing for the long term, learn about hardware wallets and proper security practices. Exchange hacks are not theoretical risks. Stay informed, but avoid daily price checking. Crypto's volatility can turn rational investors into emotional traders. Set up your allocation, stick to your rebalancing schedule, and focus on your overall portfolio performance. Conclusion. The truth about crypto and long-term portfolios is nuanced. It's neither the financial revolution that will make traditional assets obsolete, nor is it worthless speculation destined for zero. For many investors, a small, well-managed allocation makes sense as part of a diversified portfolio. The key is approaching it rationally. Small allocations, realistic expectations, and never investing more than you can afford to lose. Remember, the goal isn't to get rich quick. It's to build wealth steadily over decades. What's your take on crypto and long-term portfolios? Let me know in the comments below, and don't forget to subscribe for more evidence-based investing content. Until next time, invest wisely.